Here's your opening script. Hey, so you're checking your portfolio this morning and you're seeing red everywhere, and you're wondering what the heck happened overnight. Well, I'm here to walk you through it. Oil prices just spiked, and when that happens, it ripples through everything you own. Here's the thing. When a barrel gets expensive in the Middle East, your oil stocks jump, sure, but then inflation starts creeping up. The Fed gets nervous because higher oil means higher prices at the pump, which means workers want more wages, which means inflation gets sticky. So the Fed might hold rates higher for longer or even hike again. And when rates stay elevated, stocks become less attractive because bonds start paying you real money. So what do? You've got to reposition, maybe trim some growth stocks that rely on cheap money, maybe rotate into energy or staples that benefit when oil's up. The key thing going forward is watching what the Fed actually does, because that's what moves your portfolio next. Look, I think we've all felt this. You open your brokerage and the whole market's down 3%. 9 times out of 10, there's an oil story buried somewhere in the news. Middle East tension, a supply disruption, maybe a hurricane hammering the Gulf. And boom, oil's up $20 a barrel overnight. That's the domino that fell. And here's what I know. Oil touches everything. Energy stocks crater, transportation costs spike, inflation creeps back. That's how one commodity move becomes a market-wide reckoning. Here's what I think about oil that most people miss. An oil producer makes more money when prices spike, right? But then your airline has to pay more for fuel. They either charge you more to fly or take it on the chin and their profit shrinks. Investors see that lower number, they sell. Same thing happens with shipping, costs shoot up. Retailers' expenses climb. That tax ripples through everything. Oil isn't just energy. It's a tax on the entire economy and everybody feels it. Here's the trap. Oil spikes, your tank costs 50 cents more per gallon. Multiply that across every American every single week. Suddenly people have less to spend on clothes, restaurants, subscriptions. Companies see their sales slow way down. The Fed's stuck in the absolute worst box imaginable. Raise rates to kill inflation, you trigger recession. Do nothing. Inflation runs away unchecked. There's no clean answer at all. That's why oil shocks matter so much to the economy. They force the Fed into an impossible choice. Here's what I think. The Fed knows supply shocks are different from demand inflation. They watch for a month, 2 months, seeing if your wage demands actually change. If it looks temporary, they signal we're patient. But if they spot sticky expectations, if you're demanding raises, they raise rates anyway. They shock the system back in line. And the market watches every word. One press conference can shift oil $5. So you're not just betting on rates, you're betting on their messaging. Here's what I think about oil moves. When crude spikes, I don't panic sell everything. I shift. Utilities and consumer staples actually hold up better than discretionary stocks when oil jumps, so I lean there. Now that energy stock looks cheap, it might go cheaper. Oil at 85 doesn't mean it stops at 100. But here's the real edge. I think about what benefits from lower oil. Airlines get hammered near term, right? But if I believe oil normalizes, that's a 2-year setup. The actual move is knowing what you own and why. That's it. That's the game. Look, every few years we get one of these oil shocks. And here's what I've learned. What matters isn't that it happened, it's that you don't panic and dump quality stocks at the bottom. You've got to understand why your portfolio took a hit. Is this permanent damage or just noise? Watch what the Fed actually says, not just their moves. And honestly, these shocks have a way of forcing the trimming decision you've been putting off anyway. The real edge. Preparing before the shock hits, not after. That's when you stay cool and actually take advantage. Here's the thing, when oil spikes, it's not just about your gas prices. Inflation follows, the Fed gets nervous, and boom, your stock positions feel it. We've seen it happen. Higher oil costs force companies to pass expenses to customers, margins compress, and the market reprices the whole sector. What I'm watching is whether this holds or breaks. The Fed's already hawkish, and they hate surprise inflation more than anything. So if oil stays elevated, we're not seeing rate cuts anytime soon. That's headwind for growth stocks especially. My take: don't panic, just stay flexible. Size your long-term positions to weather the noise. Join us in the Discord if you want to dig deeper. Discord. GG/R47RZGM